Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This episode marks 1 year of the podcast, focusing exclusively on the markets and brought to you every month by our host, Parvatha Vardhini. I am the editor of BL Portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this anniversary edition is Mr. Kalpen Parekh, MD and CEO, DSP Mutual Fund. Kalpen has over 19 years of experience in sales across client segments, distribution, and marketing. He has also worked with IDFC Mutual Fund, Birla Sun Life AMC, as well as ICICI Pro AMC. Kalpen holds a master's degree in management studies in finance from the Narsi Monji Institute of Management Studies. Hi, Mr. Kalpen. Very happy to have you on the podcast today.
Thank you for having me. Looking forward.
Great. When I started thinking of what I should ask you, the best place to go to was your Twitter handle. So, because you keep updating regularly and you put out whatever your fund house has researched and, get a fair bit of idea on how your thought process works. So, one of the tweets that struck me at this point in time was the fact that you said, it's time to move into hybrids. A few years ago, maybe you were looking at flexi-caps, but now you're looking more towards hybrid. So that implies that you have some kind of worries on the market as it stands today. What are your primary areas of concern?
So firstly, Vardhini, if you go to my Twitter handle, it doesn't reveal or convey my title or organization. So in a way, it's a personal space. And of course, to a large extent, it does influence, what I want DSP to stand for and vice versa. Both of us are in harmony, which is why I am where I am. And I express freely what I feel like expressing. My second disclaimer is more often in the last few years, whatever I have felt or expressed has not been correct. So please take that as a primary disclaimer and not the usual disclaimers. Now, I have spent 25 years as an investor and, of course, as a professional in the industry. What I meant a few days back was just a very random observation when I was looking through my mobile app. So we have a new mobile app at DSP, and as a user, I keep looking at it, testing to find bugs. So the first thing I observed or the thought that came to my mind was that suddenly I'm used to seeing my flexi-cap fund or my value fund. These are the two flexi-cap long-term equity funds in my personal portfolio from DSP, and generally they were the largest holdings for most periods in time. But recently, the largest holding automatically has become my equity savings fund and dynamic asset allocation fund, which are both hybrid funds. Yeah. Now, it's not a conscious point I'm trying to make that today you should only do that. But over the last year or so, incrementally, most of my investments have happened in these two funds. And hence, its share has become higher than the other two. Now, why have I done that? The logic behind that is that generally when markets are, either frothy or expensive, valuations are high of an asset class. The other asset class, which is fixed income, or sometimes even gold. Generally, in the next 3-4 years, the other asset class, which is supposed to be a defensive asset class, ends up earning closer returns to what equities have given at a very broad level. Now, here, there are more nuances and context. I'm not getting into it, but at large, closer to 25 times earnings. Generally, future 3 to 5 year returns of Nifty have been very close to the next 3 year, 5 year return of a gilt fund or a bond portfolio. Because in the past, mostly 2-3 things have played out. Generally, from higher valuations, markets consolidate or stagnate or correct or fluctuate. And in the past, it has also coincided with a easy interest rate cycle. So we are at a point where our interest rates have risen and remained stable for a long period of time now, last 4 or 5 years. And we are getting a good carry of around 7% on bonds. And over the next 3-4 years, if there is a marginal drift downwards, bond component also could give slightly higher returns. And at 25 times earnings on simple large cap portfolios, the mid and small cap part of the market, we all have been commenting for the last year or so, have become more expensive. The odds of bonds giving similar return to equities could be higher. And hence, I'm okay to be in a hybrid fund. I'm not going to lose out much, is my thesis, is my belief for my personal portfolio. This does not have to necessarily be applied to anyone else. This is my personal reflection and personal thought. And I think that's what you picked up as your first question. Personally, in my investing, I try to keep it very simple. I have only 2 or 3 simple rules. I want to be a permanent investor, ideally. Middle class background, frugal lifestyle, reasonable earnings, high savings. I want to be an investor every month, every year for a decadal time horizon, multi-decadal time horizon. So every month, something or the other will happen. Markets are integrated with the rest of the world. So every day, somewhere, something is happening. I don't want to respond to what is happening, because whatever is happening, first of all, before it happens, I have never been able to predict that. So I have no locus standi to have an illusion that in the future also I'll be able to predict the start or the end of that. Because whenever you operate with that illusion, it actually has ended up making me a poorer decision maker on investing. So it has taken me 15 years to realize that a lot of these things are unpredictable. But what is generally predictable with reasonable amount of confidence is that if you buy an asset class at higher bands of its valuation in its cycle, generally future returns are lower and vice versa. And the third thing that is generally predictable is that if you buy good quality asset class or good quality businesses, your chances of survival are higher. And if you buy something poor or inferior, your chances of accidents are higher. So with this very simplistic knowledge, I have tried to keep investing fairly simple. If an asset class is expensive, I don't worry which carry trade will happen or what will happen, what election results will come, what will Fed do. If markets are expensive, for example, equities are expensive, I will be more in hybrid funds. If markets are cheap, however bad news is floating around, I will probably prefer to be more aggressive in my equity portfolio.
Sure, sir. So since you said you would go by valuations rather than events, so what, according to you, is expensive versus cheap? What is the metric that you apply, and how do you compare it? What do you compare it with?
Yeah, so see, of course, this is a very simplistic statement that overall markets are expensive, because when we aggregate all 50 stocks of Nifty, in history, we have seen the valuation boundaries to be from 12 times in a bear market to 25, 27 times in a bull market peak. And in the middle, somewhere at 17, 18 times is a mathematical average. More often, it remains in the middle, less at extremes. But in the last 10 years, it has been more closer to 20 times and above. Now, there are different reasons for that. One is India has relatively better prospects than the rest of the world. India is relatively more stable from a macro variables like currency, interest rates, deficits, giving more confidence. And the rest of the world is not offering so many opportunities. So a lot of money is chasing few good stocks, few good companies in India. So instead of 17, 18 being average, the averages have moved up to 21, 22 in the last decade or so. But at large, the way I look at it is that when you buy something at aggregate at 25 times, when you look at the mid-cap index, at aggregate, that would be somewhere around 30, 35 times. The earnings yield, 100 divided by 25, is lower than what it is at 15 times, 100 divided by 15. So the room for valuation re-rating is relatively lower, is the first inference I'm making. And if the room for valuation re-rating is lower, then I have to rely on only one pillar for returns, which is the pillar of profit growth. On a medium to long-term perspective. So if I look at 25-year history of our market, generally we are a country with 15% return on equity and around 12 to 13% profit growth. So if we were a single company earning 15%, 16% ROE, growing at 12, 13% over long periods of time, then 17, 18 times is the multiple one would have given. Versus that today we are 15, 20% higher. Maybe we are 1 year ahead from a valuation point of view. So there are two things I can do. Ignore that, not worry about, being slightly expensive because I am a 20-year investor. It should not matter. But to sound or feel a little bit intelligent, you try to do this optimization of timing, rebalancing, etc. So my variable is that when aggregate valuations are higher, when that asset class is becoming very popular, when everyone wants to talk about it, when people want to leave their jobs and be day traders, when entrepreneurs are selling their businesses and investing money back in our mutual funds or stocks, it is a sign that the asset class is becoming extremely popular. And what is very popular is inherently likely to not earn the highest returns. So at such points in time, it's better to be slightly prudent. So overall in my portfolio, I would have 65-70% in equities, and the balance would be in bonds and gold. And within this equity also, it is a fair mix of domestic equities and global equities. Because my idea is to own cash flows at reasonable price. Those cash flows can be from companies globally. They can be from companies in India. Not married to any one geography or one country as a long-term investor. So that's why valuations and the way I think about it at aggregate. Now, of course, there are many companies at 50 times also will make money, because if that 50 times is because the earnings is depressed, or it could be a special situation, or the company is transitioning like a Nvidia and all of them, where even at 100 times the stock is doubled. So there are always exceptions and nuances like this, but historically we've seen almost very few markets trade at these type of valuations. We happen to be fortunate to be one of them, but we cannot take it for granted that forever we might trade. I will be very happy if that were to happen. But mean reversion is a very big iron law of markets and life. And if that were to happen, I have a bond portfolio which is also giving 7-8%. See, many times people think that if you are in bonds and not in stocks, you will miss the entire return of stocks. For example, stocks have given long-term returns of 13% and bonds have given long-term return of 8%. What we are missing out is only the incremental 5, not the entire 13. So on some part of your portfolio, and why do I do this asset allocation for myself at least, is that I'm a very conservative, scared investor generally, having started my career in a very frothy bull market in 2000, after which I've seen a 50-60% correction and large loss of capital. I always feel that 20-25% portfolio in fixed income allows you to live through volatility without feeling worried. So it allows me to stay longer. So Morgan Housel has said a very beautiful line, which expresses what I want to say in better words. He says that it's better to earn reasonable returns for unreasonable amounts of time, rather than earning unreasonable returns for short periods of time. So if I want to extend time horizons for very long, I think asset allocation is a great partner to help in cushioning volatility and taking my mind off sharp fluctuations.
Understood. So as a fund house, do you believe in contrarian investing? So, because the kind of launches that you've done is all on the beaten down sectors in the last 1-2 years, IT, healthcare. And, if I see your midcap fund, I was an investor in your midcap fund, and then I found that, the midcap fund has been utterly underperforming. So are you trying to, play contrarian across your funds?
Okay, so I'll tell you, I wouldn't, again, in fact, we are doing a program called Unlabel Your Investing, and we'll be very happy to share our thoughts in a very detailed manner separately in a different context or forum. But the idea is not to have any label like growth investing, value investing, momentum, or because like I said, at any point in time, there are points in time when all of them are rising or falling. There are times one of them is demonstrating a certain pattern. What we try to do is at any point in time, what makes sense, what seems sensible, where would I put my own money or my family's money or DSP's, capital or our shareholders' capital, because they are permanent long-term investors. So at this point in time, like currently we are in the middle of 10 stock portfolio IPO, NFO, which is the largest 10 stocks, which have been the largest underperformers in the last 1, 2, 3 years. Dominant companies, but the prices are not following. So that's where the worries about slowdown and all are getting reflected, not in other parts of the market. So we are happy to, build that because it's sensible. It so happens that it may look contrarian because the market is paying attention somewhere else. And it's not for the last 2-3 years, but almost since I have been a part of DSP, I remember every product launch has been with this question that is there margin of safety from a valuation point of view? If the answer is yes. Are the companies and businesses sound? Answer is yes. We have launched an idea, not knowing whether the cycle will turn tomorrow or not. Sometimes it has turned within 6 months. Sometimes it has taken 18 months. So I'll give you an example. In 2019, we launched our healthcare fund. So you're referring to our index funds, but I'm talking about our active healthcare fund. We launched in 2019 after a 4-year low cycle. In 2020, during COVID times, when oil prices crashed to zero momentarily, we relaunched our old fund, Natural Resources Fund. So again, 5 years back, it happens to be one of our best performing portfolio. Small cap fund we had closed in 2017. We reopened after COVID crash. When the world was focusing on global tech stocks, we did a SIP NFO and not a lump sum NFO because we felt Nasdaq has crossed 7-8 times price to sales, valuations have again risen. So when something is so what we have tried to do, Vardhini, is that many times we realize that our brain wants to invest in past returns because that gives us the comfort. If last 1 year, 3 year, 5 year returns are good, we feel that the idea is good, but those returns have already happened. So you can say that we are slightly, cautious investors, conservative fund house, and maybe counter-cyclical fund house, because mean reversion, like I said, is a very fundamental force. And the idea is to exploit mean reversion in our favor rather than becoming victims of mean reversion. So that has been our effort. And the primary thought always is that can we put our own money in this fund? If the answer is yes, take it to the market. If the answer is no, wait and watch for some more time. Coming to mid and small cap strategies, I think I'm very happy with our small cap fund also. I keep looking at returns not as frequently as maybe you or our audience, because again, these are portfolios built with a 7-8 year time horizon. Our portfolio turnovers are less than 20%. We own companies for very long periods of time. And we just keep two things in mind, in particularly the small and mid cap fund, over and above other strategies, that these companies have to be really sound, run by clean promoters. Governance has to be very healthy, because in these companies, exits are not easy. Liquidity free floats are less. It's easy to get in. It's very difficult sometimes to get out. So recently there was this exercise of stress testing and all of that. We were very happy to note that our portfolio's ROE is the highest compared to entire peer group, and our valuations are in the lowest decile. So I think from a broad input perspective, we are very happy with this perspective. Now, whether in 6 months, 1 year, 2 year, it delivers the highest return or not, I don't know. But over a 10-year, 15-year history for our small cap fund or mid cap fund, it has broadly been in line with the relevant peer group who we respect, who we feel are equally competent managers. Mid cap fund, particularly in the last 3-4 years post-COVID, we are not as happy with our outcomes. We have, I completely admit that we have, underperformed relevant peers who are equally competent and credible and respectable. And though having said that, the last 4 months we have caught up very sharply. But that's too short a period to really say much about. So we missed some turning points in the market. See, generally there has been a bias to invest in private companies or rather companies run by entrepreneurs and not necessarily governments, because we have seen long stretches of poor capital allocation in public sector companies. They were cheap for a long period of time, and that was fulfilling the first condition of investing. But when will their capital allocation be good? Will their ROEs remain high? Those things for long periods of time was not playing out. Last 3-4 years, that has played out. We were a bit late in catching up on that. So that was one of the reasons why in our mid-cap portfolios, we've underperformed to some extent. Some themes like engineering, industrials, we were very early to get in. We were also early to get out. We felt at 40-50 times they have run the course in terms of valuations relative to their growth rates. But so we were happy that we made decent money in all of them. And after we got out, someone else made indecent money over and above what we had made, and they continue to rise. So these are two areas where maybe we could have been better in our execution. Like I also said, generally we are very long-term investors. If we like the broad history of the company and the management, even if they are going through a rough patch in their business, we believe that they have the acumen to take the right decisions and turn it around. Sometimes industries also go through a low cycle. We are patient through that, because generally whenever we've been patient, typically in the next 2-3 years, we have seen these companies turn around and stock prices really deliver results to our patience. This time around, that has not completely worked because if certain companies or sectors would turn around in 3 years, this time maybe in the fourth or fifth year also, it's taking longer time. So there is a decisive slowdown in many sectors, which is taking longer than what in the past has been. So these are areas where we have improved our techniques and tools to be a bit more agile, and which is reflecting in our returns in the last few months also. One bucket where even if history were to be unwound and we had to go back in 2020 and 21, which we will not change, is if you see in the last 4 years, companies which are loss-making or single-digit ROEs and remain there and have seen no change in profitability, their stocks have gone up 8 to 10 times. 8 to 10 times in 2 or 3 years. So there is a part of the market which is large, which is a large component in the benchmark, which we have not participated, which even if we go back in history, we will probably not participate because, if you happen to go through the investment framework we have on our website for our mid and small cap portfolios. So we have very clearly articulated what type of companies we will not invest in. So we look for high ROEs, growth rates, which everyone looks for, but we also go granular on forensic, on working capital cycles, on receivable days, on inventories. There are many companies which do not tick mark that checklist. And that checklist has worked for us from 2007 till 2021. So we hope that it should work from today to next 10 years also. But there are patches when what worked for us in a certain cycle is not working in a different cycle. So we hope to get you back as an investor in our midcap fund.
Sure. Okay, so since the categorization few years ago, a lot of innovation is happening on the passive side. So you have also had passive launches more frequently in the last few years. And what goes into your mind when you launch an ETF and then after some time an FOF, vis-a-vis launching an index? How do you make those choices? Because the inherent liquidity issue is there with ETFs, isn't it?
So our first bias is to do an index fund, because those issues investors don't have to grapple with, liquidity, spreads, and all of that. So our bias is to do index funds first, and that's what we did in most of our launches. The second thing that we do is completion of the basket. So there are times we just launch a theme. So like I said, the first tick mark has to be the theme has to be in low cycle. So we did technology when it was in a low cycle. We did banking this year. Last 6 months, we've been doing banking ETFs or bank index funds. So what goes in our mind is it in low cycle? So that, if we raise a lot of money, at least medium-term investor experience should not be poor. But it so happens that anything in low cycle also does not attract a lot of money. So most often, we start with smaller AUM, and we are absolutely fine with that because the experience of those investors will be reasonably better over a cycle. So when we did our global innovation fund, which was an active global fund, we did it as an SIP fund. We collected only 70 crores. After that category fell 40% in NAV. But our SIP investors benefited because they kept on averaging. And they earned superior returns because then the fund just normalized. Today, the size of the fund is 900 crores. So you start small, but the experience, takes it higher. Other reason to do ETFs is also because some components of our customer base, they need ETFs versus an index fund. Insurance companies will want ETFs and not an index fund. So we accordingly, take a call that, okay, if my audience needs ETF, some part of the audience is happy with ETF, some part of the audience doesn't even have a demat or a broking account. For them, index funds make sense. So we offer both. And let's say at some point in time, so we in the last year also launched our multi-asset fund, which will invest in underlying, themes or sectors, either directly through stocks or it could be through ETFs also. So to enable that also, it's important that we complete the range of ETFs that need to be launched. But from an innovation point of view, in last few years, what we've done is our first index fund was an equal weight fund. And globally and empirically, there is fundamental evidence that equal weighting tends to earn 100 to 200 basis points more than a market cap based index on a very long-term perspective. So the same 50 stocks of Nifty are likely to earn better returns than the same 50 stocks of Nifty if the weighting is made equal. There are obviously phases when it will underperform, but generally over a long period of time, it has delivered better. You do the same exercise on S&P, on MSCI World, similar outcomes you will see. So equal weight was our first strategy. We have not launched a mid-cap and a small-cap index fund in this cycle because, like I said, the index will also have a lot of inferior companies or businesses or, expensive names. So in the small cap and mid cap bucket, we launched a quality filter. So that's how we have been thinking about our product design.
Okay. And so we did see in the last few quarters, the top line wasn't great, but the bottom line was helped because of the base effect of low commodity prices. And now that is turning. So as we can see from the last 2 quarters. So, how confident are you of a pickup in demand at an overall level? We've seen some sectors doing very well. So do you expect the demand pickup to be more broad-based, or are you going to expect a slowdown in earnings? Because the demand is not going to be.
We have been highlighting this in 2 of our documents. One is Netra, which we publish every month. And the second one is the report card, where we publish half-yearly the report card of various sectors and what are the operating trends, starting from revenue growth, then, cost lines, margins, profitability. And for the last 2 quarters, what we are seeing is revenue growth has started to move into single digits. And profitability was still improving because margin expansion was there. But now incrementally, we are seeing a slowdown in both of them. And hence, we feel that for at least some foreseeable future, overall profit growth will come down closer to 10-12% and not 18% as we have seen in the past. So clearly, there is a slowdown across most sectors. And compared to what the market is pricing it, compared to the 15 to 20% which we generally take for granted. In fact, very long-term profit growth rates for the country at large is around 12 to 14%. Whenever we see 6-7%, it is an outlier. Whenever we see 18 to 20% also is an outlier. So, most often we see numbers in the middle. So we are now moderating on revenue growth as well as profit growth. And that's why we have been a bit conservative in our approach of either product launches or even, guiding investors for longer time horizons to invest and not expect similar rates of return that we have seen in the last few years.
Okay. On that note, thank you very much, Kalpen. It's very, very, very nice to have you here. Very interesting answers also. Thank you very much. Thanks for your time. Thanks a lot. Yeah.